August has arrived, and so has the chaos. Just days into the month, markets are already on edge, volatility is returning with a vengeance, and the headlines feel like déjà vu from past financial meltdowns. President Trump just signed a massive reciprocal tariffs order, targeting 69 countries with up to 41% duties, sparking an international firestorm across trade and supply chains. The implementation date? August 7th, a ticking time bomb for the global economy. But that's not all. The U.S. jobs report for July came in shockingly weak, just 73,000 jobs added versus expectations of 110,000. That's the worst monthly job growth in over 18 months, and the revised data from May and June quietly erased 250,000 jobs. Add to that the social media firing of the U.S. Labor Bureau chief by Trump himself, and you have a full-blown confidence crisis unfolding in real time. Markets didn't take it lightly. The Nasdaq tanked 2.24%, its sharpest one-day fall since March. Amazon led the bloodbath, collapsing over 8% after disappointing earnings and guidance. Meanwhile, tech darlings like Apple, Nvidia, Meta, and Google all saw red. Is this just a correction or the start of something deeper, darker, and way more dangerous? Now let's zoom out. Because there's a pattern here that savvy investors have been watching for years. The August curse. It's not just superstition. Statistically, August and September are the two worst months for the S&P 500, and this year all the ingredients for disaster are lined up. Overvalued stocks, rate cut speculation, geopolitical turmoil, and now, an unstable jobs market. In this video, we'll take you slide by slide through what's happening behind the scenes, from Trump's shock tariff move to the collapse in job growth, the tech-led sell-off, our winning RKT play, and finally, whether this so-called August curse is just noise or the opening act of a broader market reckoning. Let's talk about what's likely the most disruptive policy move of the month. Trump's new reciprocal tariffs order, targeting 69 nations with new duties ranging from 10% to 41%. The list includes major trading partners like India, Brazil, and the European Union, and the impacted goods range from cars and machinery to semiconductors, pharmaceuticals, and rare earth minerals. Although originally scheduled to take effect on August 1st, the rollout has been delayed to August 7th. The administration says it's to give partners time to respond, but many believe it's a strategic pause, possibly to buy time, soften the market reaction, or pressure allies into last-minute negotiations. Markets don't like uncertainty, and this move delivers plenty of it. Investors are asking, is this policy permanent? What retaliation might follow? Already, we've seen ripple effects. Brazil's currency slid, European markets dipped, and global supply chains are bracing for impact. There's also legal uncertainty. Previous Trump tariffs were struck down by U.S. trade courts for being overly broad or unjustified. This new order may face similar challenges, especially if it lacks economic rationale or bypasses proper procedures. Beyond the legal and economic questions, there's a psychological shift happening. This order signals a return to hardline trade nationalism, and it's coming at a time when inflation is already reaccelerating and global demand is fragile. Bottom line, this isn't just a headline, it's a real market-moving event. Whether these tariffs hold or get overturned, the message is clear. Investors need to brace for volatility and global friction. The August heat isn't just weather, it's policy risk burning across the markets. The July jobs report just dropped, and it's a shocker. The U.S. added only 73,000 non-farm jobs compared to Wall Street's expectation of 110,000. That's the worst monthly figure since January 2023. But it gets worse. The government also revised down May and June by a combined 258,000 jobs. That means the last 3 months have been much weaker than anyone thought. At first, the Bureau of Labor Statistics blamed seasonal adjustment issues, especially in sectors like education and government. But make no mistake, this is more than a quirk in the data. We're seeing a real trend of deceleration. Hiring is slowing, especially in retail, manufacturing, and logistics, all leading indicators for broader economic health. In response, Trump publicly fired Labor Bureau Chief Erica McIntyre via social media, accusing her of suppressing data and being part of a deep state cover-up. That sudden firing has only deepened uncertainty and raised questions about how politicized future job reports might become. Markets responded immediately. Traders are now pricing in a 75% chance of a rate cut at the September Fed meeting and over 50 basis points in cuts by year-end. That's a massive shift, and it shows how fast the soft landing narrative is unraveling. So, is this just a summer slowdown or the beginning of something much worse? The reality is, weak job data plus policy confusion plus global trade fears, a perfect storm for markets. It's no longer just about inflation or the Fed. Now, employment is flashing red. This is why August is shaping up to be so dangerous. Markets are on edge, economic indicators are softening, and the soft landing that everyone hoped for, it may already be breaking apart. The sell-off is here, and it hit hard. On Thursday, we saw one of the worst days for markets this year. Dow Jones fell 1.23%, S&P 500 dropped 1.60%, and the Nasdaq collapsed 2.24%, its worst single-day loss since March. But the real story, tech got crushed. The biggest names, Amazon, Apple, Nvidia, Meta, Google, Microsoft, all saw sharp declines. The most dramatic was Amazon, which crashed over 8% in one session after reporting weaker-than-expected earnings and slashing forward guidance. Investors had been riding high on AI hype and soft landing dreams, but cracks are now impossible to ignore. Amazon's earnings miss was the trigger, but this correction has been brewing for weeks. Valuations had climbed to unsustainable levels. Even slight disappointments now cause massive reactions. Here's the problem: the entire market was priced for perfection, especially tech. With the Fed pausing hikes and inflation cooling, investors assumed risk was low. But now, with Trump's tariffs, weak jobs data, and earnings disappointments all hitting at once, the mood has flipped. This sell-off didn't come out of nowhere. On Tuesday, we issued a 3 red lights warning in our VIP newsletter, flagging low volatility levels, VIX near-year lows, overbought conditions on RSI weak earnings momentum from key megacaps. We said a correction was coming, and now it's here. The question is, how deep will it go? One red flag is that breadth is collapsing. It's not just one or two stocks. This is across the board. Financials, industrials, even energy names are starting to fade. That means investors aren't rotating. They're exiting risk altogether. Bottom line, this isn't just a healthy pullback. This is a sentiment shift. If tech doesn't stabilize soon, the selling could accelerate. Don't be fooled. Volatility is back, and August is living up to its reputation. Get ready, because this might only be the beginning of the fall. Amid all the red this week, one stock defied gravity: Rocket Lab, RKT. While the broader market tanked, RKT soared 16% on the back of a strong Q2 earnings report, surprising both Wall Street and retail traders. Let's talk numbers. EPS came in at 0.04, beating estimates of 0.03. That's a 33% earnings surprise. Revenue hit $136 million, smashing expectations of $128 million. Margins improved, and forward guidance was bullish, with the CEO signaling AI-powered demand and strategic partnerships driving momentum into 2025. Now, if you've been following us in the VIP chat, you know we flagged this play on July 2nd, calling it a buy at $15.50. Why? Because the market was ignoring the AI plus housing combo that RKT is uniquely positioned to benefit from. Here's the story. RKT isn't just another mortgage tech company. It's leveraging AI to streamline lending, reduce processing costs, and boost customer retention. Add to that tailwinds from government housing support programs, a resilient refinance wave triggered by rate volatility and aggressive cost restructuring efforts internally, The company also revealed it has several acquisitions in the pipeline, aiming to expand its platform and enter adjacent fintech verticals. In a market where everyone is running from risk, RKT is charging forward with confidence. And sure enough, it delivered. Let this be a lesson. Even in volatile markets, winners emerge. While big tech flounders under the weight of inflated expectations, smaller, agile companies with real cash flow and smart execution can outperform. RKT is that play, and we called it early. If you're not getting these kinds of trade alerts ahead of the move, you're already behind. Join the VIP channel. We do the work, you get the edge. Next up, let's wrap with a big question. Is this just August volatility, or the infamous August curse playing out in real time? Let's dig in. Let's address the elephant in the room, the so-called August curse. Is it just a spooky Wall Street myth, or is there real data behind it? Well, the numbers don't lie. Historically, August and September are the two worst-performing months for the S&P 500. The average return during these months? 0.7%. In contrast, the other 10 months average a 1.1% gain. So yes, there's a clear statistical drag during this time of year. Why does it happen? Several reasons. Low trading volumes due to summer vacations, pre-election jitters, especially in presidential years. And more recently, central bank repositioning and hedge fund deleveraging in Q3. This year, we've got everything working against us. Extreme valuations across tech, Trump's surprise tariffs pressuring global trade, a shockingly weak July jobs report, and now surging expectations for rate cuts, which can signal panic instead of relief. Oh, and let's not forget the VIX. Wall Street's fear gauge is near yearly lows, which means investors might be underpricing the risk of a bigger sell-off. Analysts at Morgan Stanley warned last week if the U.S. added under 80,000 jobs, we could see a 2.5% drop in equities. Well, we got only 73,000 and the Nasdaq has already dropped more than 2%. That's not a coincidence. That's textbook market reaction to deteriorating fundamentals. So is this the start of the August curse playing out again? We're not saying it's 2008 or 2020 all over again. But with this mix of macro risk, seasonal weakness, and rising volatility, it's dangerous to stay complacent. If this turns into a full correction, or worse, a bear phase, we'll look back at early August and say, the signs were all there. Bottom line, prepare, don't panic, rotate into quality, raise cash if needed. And follow the data, not the headlines. We'll close out with one reminder: smart money acts before the crash, not after.